Hey everybody, this is Christopher Terry. We're going to get a webinar here done. It's market geometry and market harmonics. And for the next hour, roughly the next hour, we're going to discuss patterns, looking at trends. And basically this is going to be an offshoot to already what we have on our website. And we're just going to go through some old slides because they're still fresh for people who have not seen it before, and nothing better than to just go over some of the information over and over again. All right, so you may see me draw on the slides, you may see me do a few different things, but what we want to identify to start is what is a trend. A trend, this is an uptrend on the left, and you can see this is designated by higher highs and higher lows. That's an uptrend. A downtrend, basically, when the market is going down and making rallies that are lower than the prior rally, but yet go deeper, that's a downtrend. So it's very simple in terms of what is an uptrend or downtrend. What we look at when we look at these market trends is within these swings, a couple of things happen. Let's just take on the left. We have this. Okay, let me see if I could draw this out here. All right, we have this. Let me just make this a little bit thicker for everybody to see. All right. Okay, on the left, you'll see this rally and that rally right there. And that's basically a rally within a downtrend. You see this? Okay. And a couple of things are happening right there. We have a retracement. This rally right here is a retracement from this point up here to down here. You have a retracement. From that point, the market sells lower and has another retracement. What we like to look at in the markets are how things relate, both in price and in time. So if we look at this swing here, let's just say this swing was 10 points. It's fair to say that this may run around 10 points and give you that equivalent price structure. Also, from this market, from this high to the low to this correction up, this also falls within the 3850 618 retracement. So what we look at is both Fibonacci retracements from market high to market low, and we also look at the relationships from the prior swing to the current swing. When they line up together, then we find opportunity. Now, what we also look at is we take this high, okay, then we take this 1, 2. So let's just say we have the market high. And what we look at is the market high. Oops, I'm sorry about that. Just give me a little prep work, okay? Market high to market low. Market high to market low. Market high to market low. And what we do is we find retracements from this high to this low, from this high to this low, from this high to this low. And we may find different zones. They all come into like a little cluster. When we find that cluster, that works as a resistance or a support, depending if you're looking at the buy side or the sell side. So we're going to be looking at those. This is important to understand the trend because different things happen within the context of this trend, other patterns. For instance, the market goes from high to low, then gives you a rally, gives you a move down, and gives you another rally. Well, looking at the context, this can actually create a bit of a little what we call a harmonic pattern, where we have a relationship from high to low, and you have that pattern. And then we have a relationship from here to here, and from here to here, from here to here, and everything ties in together. So when we look at market geometry, market harmonics, we combine these pretty little patterns, well, pretty little patterns along with price structure of swing highs and swing lows and prior swings. So we like to combine several things to find and identify turning points. The other thing we like to look at when looking at market geometry is we look at the time it took to go from this point to this point, from this point to this low right here, from this point to this point, and it starts identifying certain zones, okay, on how long it took to go from here to here. So essentially what you're doing is you're identifying these turning points to come up with a spot, an area both of time and price to work with. Now, the Forex markets, I like to look at on these higher time frames, and that's great. The S&P E-mini futures, you look at them on a more smaller time frame when you're trading. However, the market's been in a funky type of chop, and I'm seeing a lot of really good patterns on the Forex side, and I'm going to share some of that with you today. Some stuff that we've been looking at, some stuff that we're looking at right now. All right, so let's give me a moment, and let me just advance these slides. All right, so what we have here essentially is a downtrending market. You can tell because the rallies make lower highs and they continue down. All right. This is an uptrending market, same principle, higher highs, higher lows. And within these structures, within these waves are other little patterns. For instance, let's just take something simple as this, and we go from this market low here, and you can start to draw in the patterns, and you could see how these waves start to work. We're not going to get into that at the current moment. We're just going to continue on a little bit. So I'm just refreshing some of the stuff that we've looked at in the past. This represents a trading range where the market essentially is, as you see here, in a range going sideways where prices are overlapping and not really going too far. All right, that's a range. This is a range. Okay. Now, as I said earlier, we look at relationships between market highs and market lows. For instance, if this market had, say, 10 points on a correction, it's fair to say that potentially this can be 10 points. So if we went from A to B around 10 points, this can possibly have the same relationship within reason. The other thing is, how does it relate in terms of retracement levels in terms of percentages? For instance, from here to here, from B to D, is this a 38% retracement or more? So when you start to have price relationships and now retracement values, things start to line up. So I'm just going through this. I know for novices this may be a little bit advanced, but we do have some other stuff on the site where it's not so advanced. I just want to kind of take this to the point where I'm going to start showing some charts, and I don't want to eat up all the time away from those that are also advanced. So if you look at this right here, Elliott wave. I'm going to stop here for a moment. We're going to talk about Elliott wave. Elliott wave, this originally comes from the Dow theory. Dow. Originally all started with the Dow theory, and that the markets have waves in them. All right, it has a big tide, they have waves, and then within these waves are little ripples, little minor fluctuations. So similar to the ocean, all right, they have their fluctuations. And in the Dow theory, he basically said that the markets will retrace from 0 to 1, or from low to high, 38, 50, 618. They'll retrace 1/3 to 2/3 of their gain, or in terms of a downtrend, of their loss. Meaning if the market went down, they're going to retrace 1/3 to 2/3 of their loss before continuing. Same thing here. Now, in the Elliott wave theory, what Elliott did was he took the Dow theory, he took all the components and the structure, and he put numbers and letters to them to give more of a structure so people can understand them. And he added his own uh, further information to it. I'm not going to get too deep. I don't want to get too deep into that, but I just want to touch upon the basics so we understand it. And what Elliott said was, you have a 0 point, you have that point, that 5, and this is considered that 5 wave. So if you ever heard of the Elliott wave, well, I suggest even look into information in terms of understanding the Elliott wave, and we have a lot of that on the website. There's some books out there. If you want, I could send you, actually I could probably put in a link into our room later on of the 5 wave, or the Elliott wave theory. Actually, let me do that. Do me a favor. So Patricia, towards the end, can you remind me to put in the link, and I'll do that. That way we don't take away from what we're doing now, and I'll put a link of a Dropbox for the Elliott wave theory. Right, so just remind me. So Elliott basically said that the market goes in waves, and it goes in a 5 wave. Now, many times it does go further into a 7 and a 9, but typically you'll get 5 waves, what some people call 1, 2, 3 drives, or any kind of 3 pushes. My ex-partner Linda called it 3 Indians in her book Street Smarts. However you want to call it, the market moves in waves, in series of 3 drives up and 2 corrections, or 3 corrections actually. So the 0 to 1, then you have that retracement, and then you have that 2nd to 3rd. Now the 2nd to 3rd is important because you'll know that this is in part of that Elliott wave, is when you have this higher low, this first higher low, and then the second wave up here is massive. Many times you'll see this. The low will come in, a low will come in, a market will rally, come all the way back down, and then drive up like that. And when it's trying to make its move back down, it makes you feel as though it's going to make new lows. It'll stop and it'll drive up real big, and this starts that whole structure of that Elliott wave. What I'm trying to get at is the market moves in waves. These corrections right here that come down come in smaller waves, and that's what we're always looking at. For instance, if you have a structure like this, I'm going to break it down a little bit later when we start showing patterns, how everything starts to tie in. Elliott wave, harmonics. Here's an example of some market harmonics where you have the Elliott wave, the 5th wave, then you have that ABC corrective wave. The ABC corrective wave has little price ratios and relationships in them, which we're not going to get to just yet. I'm going to get to them. Has retracement levels, what we call extensions and projections, and it draws out this little pretty pattern, whether it is a Gartley or a butterfly or a crab, all these crazy names they put to it. But the market, in terms of Elliott, also has relations to what we call harmonics. And you start understanding both of them, you're way ahead of the game. So let me continue. Okay, now we're going to start getting into some numbers where we can make a little bit more sense, okay? All right. So we're first going to look at retracement levels, and this is the most important. So remember, we're looking at the trends up or trends down or swings. Here's your low, here is your high. And typically after the market goes up, now this right here, this swing right here may come in the form of small waves up. And this may come in the form of corrective waves down. Same thing here in this process. It may look like that in reality. Okay. So when the market goes from low to high, we're expecting a retracement. And the most common retracements are your 38, your 50, and your 618 zone. All right. What we're going to start doing is laying out how we look for horizontal support. And we'll get to all the other pretty stuff later on. So your market goes from high, low to high, and then you have your retracement level of 38%, 50, or 618. And that's called a retracement of a trend up. Now, if it's 38% or less, as you see here, 38 to 50% or less, that's a shallow retracement. That's saying that the market's real strong. If it's a deep retracement and it comes all the way down here, although the trend is up, this is a much weaker retracement. A lot of times, if you see the market, and I'll get ahead of myself, if you see the market do something like this, come all the way down deep, then come up, it'll put a lower high, and then come deeper, and that sets that structure for other patterns that we look at. So when you have a deeper retracement off the bat, right down, that tells you that potentially the move up will be less strong. If you have a market that runs up, comes down shallow, it's telling you that the market is stronger and can have a much larger move to the upside. All right, we just looked at this, and basically a bullish market is made up of 5 waves. However, there can be 7 or 9 waves. And this right here, not going to get too deep into, is basically that same 5-wave structure showing smaller waves within it. So if you understand, we have the main tide, then you have the wave, and then you have the ripples, similar to the ocean, if you want to keep it as simple as that. And as we said earlier, if you look at 1 to 2 and 3 to 4, and even 5 down, a lot of times you'll see that they relate in degree of price swing. So if one is 10 points, the other one should be around 10 points. Elliott wave and Fibonacci structures. Okay, let's take a look. From 0 to 1 and from 1 to 2, many times you'll have that 50% to 618 retracement. What's important is from 2 to 3, that 4th wave down is typically only 38 to 50% and stays above the number 1 area. This is just the basic Elliott wave. We're going to get to the market harmonics and other things in a minute, but I want to at least get the basics out of the way again. Okay, let me continue. Hold on. Okay. Again, we look at the Elliott wave, the 5 wave, and how this type of pattern formed. Same thing can happen down here. The same things can happen down here, but they also can happen up here in a trend. All right, so this is a very, very bullish pattern. If you see this in the context of an uptrend, if you start getting those type of retracement patterns. We spoke about earlier those retracements in a trend. For instance, the wave up does like this, right? The 5 wave. Well, these right here, these 2 swings are similar to this, all right? And what does that mean? Let's look at this together. Impulsive, you're going up. Corrective is going down. Impulsive is going up. corrective is going down, impulse is going up. It could be reversed in the sense of a downtrend, that the impulse is the trend direction and the correction is the pullback. We look at A to B, C to D in terms of the impulsive relationship, and we also look at A to B, C to D in terms of the corrective relationship. So that's all that is. This is just identifying this right here is identifying this, and this and this is identifying this and this. And as I said, we have this up on the site for those who want to get more involved in that. Okay, projections and extensions. We have three things we want to look at. One is retracement levels. Retracement means you go from low to high and the market retraces down. That's the first form of using Fibonacci or derivatives of Fibonacci. The second form is projections. Going from A to B and from C to D. A to B and C to D. These are projections, which means that, let's just say this is 10 points. A to B is 10 points. And then you take that times a percentage and you get CD. Typically, everybody looks at this as the measured move of 10 points. What if you had a 1618 projection? This would be 16 points, 16.8 on the C to D leg, you see? And the reason we look at this is because this ends up tying into other things, other retracements, and we look at all the numbers and how they relate to one another. What if there was a major resistance here and this was only 9 points? Well, it would be 88.6 of the A to B would land right into that area. So this is why they have those. Extensions are basically, as we have drawn out, is from B to C up to D. All right, B to C up to D, or as I noted, A, B, C. So meaning that if this is 10 points and we had a 200% extension, this would be up 20 points, you see? If this was a 141, this would be 14 points. That's how that works. And these are just the basics. Now, this is starting to pick out some of the most important things we want to watch, where we have the 5 wave, as you see here, you got low 1, 2, 3, 4, 5. But what's important is every time the market's made a swing low, it's left a price point. And every time it leaves a price point, it becomes important to the next swing, meaning that the low, we tie it into the high. The higher low, we tie it into the high, you see? And by doing that, we look at a couple of things. We look at the prior retracements, how far they went, plus the retracements on low to high, and we end up looking at areas of commonality where you have multiple clusters of retracement areas, of price relationships, and that's what happens is you'll find areas where everything starts to line up. We also look at from high to low, this right here, these two swings. So this is what we end up wanting to watch, turning points. All right, so I'm getting you guys prepped up before we actually look at some charts. So here's a good example of the harmonic type of work, where you see a low, you see a higher low, you see another higher low, and you see how we can take that swing low, we take this swing low, and then if the market makes its corrective waves, all of a sudden, this has a point of information, this point, this all ties in together at some point. We look for support to come in. Okay, and here are the pretty patterns. This is what they look like. And then we're going to get on and start looking at some actual charts, and I'm going to draw it out of some of the stuff that we look at. All right, so give me a moment. I'm going to get the chart set up, and then we're going to come right back. Okay, I'm going to use, actually, what I'm going to do is we're going to use the MetaTrader 4. All right, give me a moment. Okay, we've been sending out swing trade alerts. If you guys have noticed, we put that in an email form. We send it out with the charts attached and all that good stuff. So I'm going to go over a couple of those that we had sent out and get you guys more familiarized with what we're looking at. So let me find the first one, which was NZDCHF. Now it's probably right in front of me, and it's going to take me 5 minutes to find it because that's just the way it is. Let me get rid of some of these. I can't get rid of those, but I'll find it. NZDCHF. All right. So we're going to look at this for a moment. Okay. So what we're looking at here, and let me just get everything drawn up here promptly. So what we discussed before is we're going to look at turning points, swing highs, swing lows, points of interest for us to lay out levels and zones. For instance, we can see that the market right now is creating a wave up. Let me see if I can put the color there so we can see this. Okay, yes, you can see it. I have this up on my other computer, so I'm watching everything I'm doing. Okay, so right now, overall, where is the market? The market high to low is making a retracement. So technically, the market is in a range, but it's not in an uptrend. It's in a range, more or less in a downtrendy type of market, except it's getting a big correction right now. So what we want to identify is where the market trend is. It's in a range. All right, market price is obviously lower than the prior swing high, but the smaller time frame, where is the market? The market is making a series of higher highs and higher lows. It's making those multiple waves up, as we discussed, right? It's making those multiple waves up, and we want to start identifying retracement zones, areas to watch. Eventually, what we want to do is draw out a pattern that makes sense, a harmonic pattern that ties into the market geometry. And this, I'm sorry. And this is some of the stuff that we've sent out. And I'm just going to start pointing out some prior charts that we've done, which will make some sense to you. Okay, if I can get this, here it goes. All right. So if we take the market high, and you click on the Fibonacci button, if you're looking at Forex, Fibonacci, and this is where I want to start teaching you a little bit more and how to use this. So that way tonight, you could play with the buttons. All right, there we go. So Fibonacci, swing high to swing low. See how we did that? You press it, you right click on the levels. What I like to use is, as said before, 786. We use 886. And then what I like to do is get rid of the stuff that we're not going to need. All right, we're not going to need this. All right, as you can see, that's the first area to watch, which is the 786. And the 786 is a derivative of the 618 retracement, and all that is on our prior videos on the website, which we don't particularly have enough time to do today, but I'm going to get into more of that in the future. Maybe next week we're just going to start from the basic, but I wanted to get something out there with you guys in terms of harmonics, kind of continuing of where we left off the last time, because we had some really, really good patterns. And I'm going to go through maybe 3, 4, or 5 charts today, all right, and show you some of the stuff that we sent out and why. Okay, the other thing we want to look at is we have a retracement zone. We see that. Now the other thing that we talked about is what? We have extensions and projections, right? So here's your extension from low to high. That's what we call an extension, where the market has here, here, and extends up. And what we're looking for is clustering of price patterns, of retracement levels. Sorry about that. So we take that high to low, and the thing with MetaTrader is you need to always go in and change the stuff that you're looking at. So in this case, this is a 1272 extension. Okay, and we could see, if we take this, we change this to magenta. All right, we could see that the move up from high to low up lands right at that 1272 extension. We also could see the market high to market low lands right at a 786. We also see that the next swing up is an 886 on a retracement and a 141 extension. We also see that potentially we have another level above. The reason I'm mentioning these other levels up here is for the pure fact the market hit, bounced off, and it may try to drive up again. So we're putting in the levels now to watch to see how they play out. Okay, now we're taking this, okay? And we're going to take this and we use blue. And what we did here, and this takes time. You're not going to learn this in one night. So you take this swing high, swing low to swing high, and then what you're doing is you're projecting up that same swing, but you're adding your Fibonacci extensions to it. So that's a projection. See the 1272, the 141. So this 1272 is basically 1.27, 127% more than this swing. So if this was 10, this would be 12.7. All right. So the main thing that we're seeing now is how everything is starting to relate in terms of zones. Obviously, it's telling us a couple of things. Let me just fix the color on my thing here. This is your first area. That is your second area. This is a third area to watch. So if you're looking at this market, the NZDCHF, you're saying to yourself, well, we're getting these price patterns up, these 5-wave type of patterns up, within the context of a bigger range. So you're looking at where resistance can come in. The other thing you always want to do is look in the past. Okay, if you see here, there's a bunch of data, overlapping price bars all in here, and that's also a resistance point. You always want to look at the past and see what happened going forward. So if we were to start drawing in some patterns now, we would start laying in some patterns. Let me show you what this would look like. The pretty pattern. Okay, let me just fix this first. Let me draw in the pretty pattern. There it goes. Let me get a better one. Okay. So what I like to do is I draw in shapes all the time. Got 1, 2, 3. That's your first zone that you're watching. That's your first area. The second one is you're drawing in high, low, and you start watching your targets. We did this and we sent out the swing trade alert, if you recall, that was the level that we were going to watch. All right in here. This is the level that we watch for a short, and you could have had your risk well above. I believe that's where we had put it. All right, so if you're looking at how everything's starting to tie together, this was a pretty good area to watch safely and to see what happened. We were looking for a bigger move down. It didn't give it, all right, yet. It's still in the context of this whole swing. So if this market's to still turn and turn down, this is still valid. That point is still valid. Now, let's just say that the market goes a bit higher. Where else would we watch? We would take the same points to watch and drive it up here. So we would have another zone well above. All right, so we would watch not only this point here as a resistance still. If it starts to drive further, we would wait and be patient until it hit up in this zone. This is how you start using market harmonics and price patterns. You're clustering everything together. All right. I'm going to be doing an advanced class for the Traders Expo, I think August 5th. And I'll send it out on the website, but I was invited to do an advanced class on this stuff, and we'll be doing a lot more of it. But basically, you guys have this whenever we do it as much as you want, so we record them. All right, so right now we would keep an eye on this, not doing anything obviously. This is still a key resistance area. Even if this comes up to this area and turns down, let's take a look on a smaller time frame. Watch. All right, let me just bring this to a smaller time frame. Okay, so now what we did was we have the larger time frame. Now we have the smaller time frame on how we want to identify zones, right? So let's look at this again together. You have your bigger term time frame. Let me get rid of this. All right, you have your bigger term pattern. Now I'm going to make this a smaller time frame. See that? Well, I was. Okay, you still are. Some news must have come out. Anyway, so what you want to do now is, now that we've identified this as a main resistance point, is you draw in your patterns once again. Defaults. Now obviously this is going to be at a 786. Oops. Okay, we start identifying from this swing up. So now we have the larger term resistance in place. Now the market's making its way back up again. And forget where it is right now. It doesn't matter. I'm gonna start laying out stuff for you. So what we're looking at now is we're taking that swing higher where the market originally hit, and now we're looking at the smaller time frame on the retracement back up, and we're going to draw in patterns again. And we're going to identify the resistance. So we see just right off the bat, we see that the market high, I didn't mean for that to happen. Market high to market low, we have this first area resistance, that's 786 to 886. A lot of times you'll get that. The market will break down, turn back up. So that's why I said this stays as valid as it is until that's broken, and if the market rallies past it, which obviously it's not doing right now. I don't know why it turned down like that real quick. Must be Patricia over there selling big, right, Patricia? Okay, then we're going to take this lower high and we're going to drop this in there. And then what we're going to do is we're going to get rid of the 786. See that? And we're going to change the color. Make that yellow. Then what we're going to do is, once again, we're going to take another high to low. All right. And we're going to right. So if you look and see, let me just change the color of this. All right. Okay, let me show you what I'm drawing, okay? Market high to market low has retracement. Market high to market low has retracement. Market high to market low has an extension. You see how what I'm starting to do is I'm starting to find some commonality zones from all these swings as they play an important role. All right. We still have more. We have this swing. And let's just make this a magenta. All right. And then we're also going to look at what? We're going to look at this move up. See this right here? All righty. Two, 7. And this is what I do. I do hand charting. I literally do this every night, every day when I'm doing my work. Always doing the hand charting because it's the best. It's the best way to do it. If you rely on a computer to do it for you, you kind of lose the feel and lose your touch. All right, let's just get that in there. And let's also add a 1.13. A 113 extension is important. All right, so see what we have going on here now. Let's draw in some more. Let's start from the beginning. Market high to market low. Market high to market low. Market high to market low. We see that these are all retracement levels. Then we take the market high to market low up. We also take this swing and this swing. All right, so basically we've covered all the bases necessary of where resistance can come in. And we could see right away is this is a good area of resistance, this is a good area of resistance, and that's a good area of resistance. So should we have been watching the market at the time and we wanted a short, this would have been a good area to short part. This could have been an area to short partials, and your risk could have went up here. So safely you could have entered more and put your risk up here. Let's draw in the pretty pattern. Okay, let's draw in the pretty pattern. Insert shapes, triangle, high, low, here. Insert shapes, triangle, high, low, here. Okay, this is how we have our X, A, B, C, D. So essentially, you're drawing these resistance zones, these little commonality zones, and you're always looking for X, A, B, C, D. You're always looking for that market geometry. So you guys getting it so far? I know it's a little bit advanced, but you know what? Here's the good thing. We could do this over and over and over, week after week, right? And you can see what happened once this market hit. It hit this little spot right here, and it found a very good resistance. And that's how that looks. Okay, wait, let's just find. So you see how that looks? All right. So although you have the bigger picture, you have smaller pictures within that, all these always forming these commonality zones to watch. Let's draw, I have a good one we're watching. Any questions? Anybody? Any questions? Uh-oh. I guess my maintenance guy's at the door. He has a question. I'll be right back. Okay, I'm sorry about that. Okay, so if we're looking at this chart on where the market can come next, let's look at some levels to identify where the market can go down. All right, since we're still on this AUD NZD or NZD CHF chart, let's identify how far the market can come down. So what we would look at is once you're in the market, you would look at a 38% to 618% retracement. And that's not what I would look at. There it goes. All right, so I would look at retracements back down into these zones. All right, so what we would basically essentially do is, let me just draw this out real quick. Okay, you see how this looks? So you're starting to see, gang, is how we would look at this in terms of harmonics. Okay. Somebody's asking, are patterns more meaningful on any pair or any time frame? No. Any market, any time frame, it's valid. For an indicator or a pattern or a method to be valid, it has to work on any market, any time frame. So what we're looking at now is where the market can go to the downside. So I'm looking initially at what the structure is here. So let's take that away. Let's start looking at, oops, I didn't mean for that to happen. I don't even know how that happened. Okay. So if we take this, all right, so if we take this and we add it just on the yellow, all right, watch what we start doing here. Okay, you're starting to see how this is coming together. What we're doing now is I'm taking the low, the high, taking this, and now I'm projecting back to the downside. And basically all we're going to start doing is start laying in the foundation. Now we want to look at this last swing high of how far the market can come down. So for instance, this high right here, and you can't see that, this high right here to low, we want to also get that. So I'm going to pick that up right now. So we're going to take the Fibonacci. We're basically going to go from low to high. And we're going to do this. Okay, and we're going to say use blue. We'll try that again. 0.0, 1, and then we'll go 1.13. Let's see where that lines up. Okay. So what I did was I took the market high to market low on this swing, and now I'm projecting this down, and a measured move as we discussed before. So if I take in the shapes again, shape, triangle, and I'm going to change this here, here, here. Here, here, here. And you can see how that looks pretty similar to what we started off with. If you recall, we started off with this is what can happen within the structure of a trending market. You follow? So this is, if you look at it, this is actually what's going on right now in that CHF. If you look at it, we had this pattern, and now we have that pattern coming into play. And this would be your X, A, B, C, D. All right? So let's take a look at a couple of other ones. The NZD, AD, Here's another one. A nice clean chart for us to look at. All right, let me just get everything straight away. Okay, this one, basically we found, and this is one of the ones we sent out on our swing trade alerts. If you recall, let me see if we have it here. I don't know where it is. It must be gone. All right, no problem. Okay, so let's identify the swings. Let's identify what we are looking at. So the first thing we want to look at is here is your first retracement. Here's your second, and this was one of the ones we had sent out on the alerts. How did we identify that? Let's go through it together. All right, first things first, we could see real clearly this big swing and this big swing look almost identical. So that's one of the main things we're going to look at also. That looked identical. So let's start with that. Let's start looking at the price relationship, that A to B, C to D relationship. Okay. So right there off the bat, we see the relationship of that A to B, C to D, which means market high to market low, market high to market low are pretty exact in terms of its pricing, the price swing. That's one of the first things you want to look at, where your relationships are. The other we start looking at is retracements within the trend. We're going to take the low to high, and we're going to place here. We're going to drop in a 786, and we're going to drop in an 886. Right, so, and then we're going to change the colors, of course. We're also going to look at this last swing up. All right, so we're going to look at this swing here up, and then we're going to lay out the 113, extension, and we're going to lay in, let me just see what else we looked at. I'm trying to remember what we looked at the time. I believe that was it. All right, and what we ended up getting was market low, market high, market low, market low, market high, market low. And it came right into, as I believe, came right into this zone right here. And what we were watching was any trading from this point down to this point was a buy zone, and our risk had to go down here. So obviously you on a daily chart, you'd use a lower position size. And essentially what we did was we drew out this X, A, B, C, D, and your risk would be a lot lower, or you can even come down here with your risk depending on how conservative or aggressive you want it to be. This also is nearly like what we call a cipher pattern. All right, almost what we call a cipher pattern, where you have your X, your A, your B, your C, your D, and C is above A and D is below B. I'd like to see D come a little bit deeper, but in this case, the market found all these little commonality zones in here, and now we're coming back up to the upside. All right, so we had sent out an alert, I believe it was yesterday. All right, we sent out an alert yesterday looking at what's next. What's next with the AUD NZD? And let's take a look at that. So now we looked at the sequence of the market had a higher low in a range, and now it can come up to a whole nother area, and that's what we're going to start focusing on now. All right, so just give me a moment. Let me clean up this little chart here. All these fibber lines and triangles and everything. Let's get rid of them. How about that? Yay, everything's cleaned up. Okay, just give me a moment to get this straight. Okay. All right, excuse me for 1 minute. Okay, so we're watching the AUD NZD right now, and we got some key levels to watch. And this is what I'm watching on this. Then I'm going to show you one of the markets that we're looking at presently. So what I'm doing is I'm putting in my fib ratios. All right. So now I'm putting in my fib ratios, and I'm watching these particular zones. One point 62, 1.162. We got 2. So the purpose also of this webinar is to show you how to use MetaTrader 4, actually. All right, and 262. All right, so as we see here, the market has some price relations that we can look at. Let's open this up a little bit more. And the first thing that we see is potential for a shape triangle. 1, 2, 3. Short shape triangle. 1, 2, 3. All right, so again, we have that cipherish type of pattern where this area right up in here is a good resistance to watch. If you're shorting, if you're looking at a short side up here, you keep your stop. You can keep your stop up here. If you want to be conservative, more aggressive, you can keep it right in the middle up here. And let's just say you're shorting this, what you would look for is around 38 to 50% back down, at least around like something like this, 38, 50, 618 retracement. So this would be a short zone, aggressive risk, conservative risk, and then you have your downside. So I like to look at these patterns where they start to line up. You have your X, A, B, C, D. Let's look at one more chart that we're actually in the trade right now. And again, just hold on and let me get to it. We took a trade the other night out of it, did okay. Okay. Give me a moment. Okay. Here we go again. All right. Sorry about that, gang. All right, so now we're going to look at this chart one more time. We're going to look at the EUR-USD. We're looking at this and looking at a zone down here to pay attention to. We know the market's been weak, but yet we want to be proactive in drawing our levels out. So essentially what we're going to draw in is this. Just basically looking at some market geometry and how everything starts to line up. So we take the low to high. We're taking 1.27, 127. We're taking this swing here. And sometimes it just takes a little time to find out where the patterns line up. Okay. That's the one thing about MetaTrader is, there it goes. That's the one thing about MetaTrader is that it's a pain in regard to having to redo your numbers every time, because it saves the last digits. Okay, here. So we're going to look at maybe 1.62, 1.62, see where this comes in. All right, and then we're going to do a 141. All right, we'll be done in a few minutes. So what I was saying about earlier was you have this swing and this swing. That's 100%, but coming down here is a 141. See that? So that gives you that extension right there. All right, and then we have this swing right here. See that? We have that swing. So if we start to draw this in, here's what we're going to end up with. All right, that's your first part of the triangle. That's your XAB. I'm going to insert shapes triangle here, here, here. Here's your X, here's your A, your B, your C, your D. D's down here. So we know this whole zone is a good area to pay attention to for support. Should this market start to just get back, it looks like it's trying right now, start to get back above this zone, we can see that the potential for upside is great. Now, how would we measure the upside? What I typically like to do is I look at the prior swing right here. See the swing? Let's just take this and call it that. I take that and I do this. So if I'm looking for upside, that's what I'm looking for in terms of the price relation. The other thing I'm looking at is that 38 to 50%, right? Delete that. Okay. So what I'm looking for is if this market stops going down and turns up, what do we have to look at? We have our A, B, C, D. All right. So we have our price zone to watch on the way up. So watching this area as support, should the market start to turn up, here's your minimum targets to watch. All right. Okay. Right now, we're just going to pretty much end this webinar. We're going to do another one next week, probably around the same time next Wednesday. I'm going to be getting into more advanced things, but today was just more of a refresher plus a little bit of advanced work, and then we're going to start getting into more and more patterns, some of the current stuff that we see going on. And as I recall, I did promise you guys the Elliott book. So just hang tight 1 minute, and let me see if I could find that book. Okay. All right, I put that book right into the room so everybody could see it. That's my desktop. Let's see if I can show you. That's that's my desktop. That's what I look at all day long. So, okay. Anyway, I wanted to hopefully get through and give you some good information. And I'm going to record this. I will send it out to everybody who's on the IML website, obviously. And let's have ourselves a great night. And let's rock and roll. See you guys in the chat room in the morning. Thank you.